Good afternoon, everybody. It's Doc here from OnTheMoneyOptions.com and Coastal Capital Management. It's Sunday, May 20th, and I want to share with you today a process that I call the Active Protective System, or APS for short. Now, this is something that I do with all of my stock positions. This is not something that you're typically going to find in the retail world. Most retail financial advisors aren't aware of this process or this system, and probably if they do, they were not allowed to use it. So I want to share with you today how I do this process and how you might be able to do it for yourself. One of the things that is always a concern, it's a lot easier to figure out when to get into a stock than it is when to get out. And the problem is, and the reason for that is, it's because most of the news that happens with a stock happens when the market is closed. And there's a reason for that. They don't want the market to be able to react to their news. So you'll see that earnings on stocks are often put out just before the market opens or just after the market closes. The stock market's only open 6.5 hours a day, and there's 24 hours in a day. A lot of things can happen during the time that the market's not open, and you don't have an opportunity to react to it. So this active protective system here is on guard 24 hours a day, 7 days a week. And if anything happens, we're already set up to protect our position. So I'm going to walk you through an example here. This example I'm going to show you today is Celgene. Celgene is in the healthcare sector. And back in last June, I believe it was, when we got into this position, this is an actual position that we got into, the healthcare sector was outperforming the S&P. And Celgene was outperforming the healthcare sector. So this is an excellent stock to keep an eye on. One of the things that I watch for is a stock that breaks out to new highs. It takes a lot of work and a lot of effort for a stock to break out to a new 52-week high. If you look here at this chart of Celgene, and this is back last fall, this is last June, you can see that it touched this level here about 3 times, and then on the 4th try, broke out on very strong volume and moved up. This is an excellent opportunity to get into the stock. We got into this stock at $126.70, and immediately I put in place the active protection system. When I buy a new stock, I immediately buy protective puts that are 10% or around 10% below the current price. So we got in at 126. 90% of 126 would be 114. There was a 115 strike for the July 115 put. So I bought the July 115 put. So right away, we've got a situation where this stock will be put out if it dropped very quickly below 115. Now, in order to pay for that 115 put, what I did is I went above the current price and I sold a covered call. And I sold a covered call for more money than it cost me to buy the July put. Now, a covered call basically gives someone the right to take the stock away from you. And if you're selling a covered call at a price higher than what you paid for the stock, then in order to get called out of the stock, you're immediately in a profitable situation. So my main concern is not how much money I can make, but how much money I could lose. So I use the income from selling the covered call to buy the 115 put here. Now, let's switch to the next chart. The next chart here is a little bit further out in time. And you can see here that the stock moved up into the 135 level pretty quickly after we bought in. Now, as soon as I can, my interest is moving my protective put to at least the price that we got in or very near it. So my goal over a short period of time, as short as I can, is to move my protective put up above the price that we paid to get into the stock. And doing so, I'm protecting the capital that we've spent on any position for me and my clients. So in this point here, you can see that in the next expiration cycle, I moved the puts up to the 125 level. I moved the puts up to the 125 level and paid for them by selling covered calls up to the 140 level. And since I sold the calls for more than it cost me to buy the puts, once again, I bring additional income in while moving up the protection. So let's move out to the next one. This is over a period of time. You can see this is September, October time frame, and you see that Celgene has moved from the 126.70 level that we were in up to the 145 level, and we've got a nice position here with a good return. Now, on option expiration here at this point in time, I believe, which was the September expiration, I moved the puts up to 140. No, I'm sorry, I moved the puts up to 135, this 135 level here, which is just below the 50-day moving average. And I paid for that by selling a covered call that was out pretty far. And I'll go over some of that information in a minute. But the point is, at this point in time, we are in a stock at $126.70. We have protective puts at $135, and we have spent no money creating that protection system. So this is my active protection system. Now let me show you what happens shortly after this. Shortly after that, you see that the stock market, well, not shortly, this is a lot of time after it. This is the end result of what happened with the stock. Very shortly after that last screen, the stock dropped down to the 125 level, and then made a really strong move down to below 100. And over the past several months has dropped down to as low as $78 a share. So this is a stock that is about half of what it was recently. Now, in anybody's book, this is a depression for this particular stock. So when people worry about the market going into a recession or a correction or a depression, I don't worry about the stock market as a whole. Individual stocks do this every day. So what I want to do is I want to protect our position, individual positions, from something like this happening. This was completely unexpected. There was some information that came out by the FDA that wasn't received well by the investing public, and then you see what they did to the market. Now, what happened here is that we were able to come out of this stock at the $135 put. At the same time, I was able to buy a put that I had, covered call that I had sold for $12 I bought it back for $7. So when I sold the covered call and bought the $12 in, that brought in the money that I used to buy the 135 put. I bought the 135 put at $1.09. So now the stock is below the 135 put level, and I've also got a pretty strong profit in the covered call that I sold, and I actually made $5 on the covered call buying it back. So if you add the $5 on top of the 135 put level, you can see that we're effectively out of the stock at $140 a share. Now, we bought the stock at $126.70, and we're out at $145. We preserved a pretty nice return on our investment in about a 6-month period of time, and we've avoided this type of action from happening. So this is my active protection system. It works 7 days a week, 24 hours a day. The market doesn't have to be open. A lot of these big moves that you see here on Celgene took place after the market closed. And then you have absolutely no opportunity to protect yourself. So this is my active protection system. I hope it makes sense to you. I hope you can see where we're able to take our active protection system and generate the income that it takes to provide the protection. So until next time, this is Doc. As I always say, trade carefully and stay hedged.